Almost a century ago, Henry Ford famously said that if the average American truly understood how the banking system worked, there would be a revolution by the next morning. Whether you agree with him or not, it's a quote that still gets people thinking today. That doesn't mean banks are the enemy. They provide essential services, keep our money secure, and make everyday life far more convenient. After all, very few people want to stash cash under a mattress or bury it in the backyard. Well, maybe a few still do. But here's the reality. Banks are businesses. And like any business, their goal is to generate profits. A significant portion of those profits comes directly from the people who use their services. Whether you're taking out a loan, swiping your debit card, or simply leaving your paycheck in a checking account, there are countless ways banks earn money from you, many of which most customers never notice. That's one reason bank stocks have historically been such strong, long-term investments. The first thing most people don't realize is that the money sitting in their bank account isn't literally sitting in a vault waiting for them. Even if you have a substantial balance, it's mostly just a digital record. Banks take the deposits they receive and use that money to issue mortgages, auto loans, business loans, and other forms of credit. In other words, while you still own the money, it's constantly being put to work generating profits for the bank. That became painfully obvious during the 2008 financial crisis. As panic spread, millions of people rushed to withdraw their money at the same time. The problem was that banks didn't have enough physical cash on hand to satisfy everyone all at once. That's because of a system known as fractional reserve banking, which allows banks to lend out a large portion of the deposits they receive rather than keeping every dollar in cash. Does that mean banks are unsafe? Not necessarily. In the United States, deposits are protected up to certain limits through federal insurance, and regulators have systems in place to help maintain confidence during financial crises. For everyday banking, that's enough for most people to feel comfortable keeping their money in the bank. Just remember that your checking or savings account isn't a storage locker filled with cash carrying your name on it. Your money is constantly being used throughout the financial system to generate returns for the bank, not for you. As an individual, you can usually access your money whenever you need it. But if everyone tried to withdraw their deposits at the exact same time, there simply wouldn't be enough cash available to hand out. The second banking secret involves foreign transaction fees. If you've ever traveled outside the United States and used your debit or credit card, you've probably paid extra fees without giving them much thought. A friend of mine learned this the hard way after a 2-week vacation overseas. When he checked his credit card statement after getting home, he discovered he'd been charged more than $120 in foreign transaction fees that he never expected. The reason so many people get caught off guard is that these charges often receive very little attention. If customers fully understood how much they were paying, many would choose different payment methods or cards that waive those fees. Today, plenty of travel-focused credit cards charge no foreign transaction fees at all. But if you don't have one of those cards, those extra charges can quietly add up throughout your trip. The third secret is surprisingly simple. Check your bank and credit card accounts regularly. Most people assume every transaction is correct, but unauthorized charges, billing mistakes, and even fraudulent activity happen more often than you'd think. If you notice a transaction you don't recognize, contact your bank immediately. Under U.S. Consumer protection rules, reporting unauthorized electronic transactions promptly can significantly improve your chances of limiting your losses and getting the issue resolved. Waiting too long can make the process much more complicated. The bottom line is simple. Nobody is going to watch your money more carefully than you will. The fourth banking secret is one that surprises a lot of people. Your banker may be friendly, but that doesn't necessarily mean they're acting as your financial advisor. They'll remember your name, ask about your family, congratulate you on milestones, and make every conversation feel personal. But in many cases, they're also working towards sales goals. A banker once explained to me that building trust with customers was a major part of the job. Once that relationship was established, it became much easier to recommend new credit cards, personal loans, home equity lines of credit, or other financial products, even when the customer hadn't planned on borrowing money in the first place. The reality is that many bank employees are evaluated based on sales performance. Meeting key quotas can affect promotions, bonuses, and sometimes even job security. That doesn't mean every recommendation is bad. Some banking products can genuinely be useful. But before agreeing to any loan, line of credit, or financial product, ask yourself one simple question. Would I still want this if nobody had suggested it to me? Never let a friendly conversation replace careful financial decision-making. And before we continue, if you're enjoying this video, you may also like my free newsletter where I share practical investing ideas, money strategies, and personal finance insights that don't make it into these videos. If you're the kind of person who learns best by seeing ideas explained visually, not just hearing about them, you'll probably enjoy my free newsletter as well. I break down investing, personal finance, and wealth-building concepts with simple charts, illustrations, and real-world examples. If that sounds helpful, you'll find the link in the description below. The fifth banking secret is that banks make money almost every time you swipe your card. Whether you use a credit card or a debit card, every transaction generates processing fees. Most people never notice because they only see the final price, but behind the scenes, the merchant is paying those fees. Imagine you buy a $500 television with your credit card. If the processing fee is around 3%, roughly $15 disappears before the retailer ever receives the money. Businesses know this, so they often build those costs into their prices. In other words, everyone ends up helping cover those fees, whether they realize it or not. Banks also make enormous amounts of money from credit cards themselves, which explains why they spend so much money offering welcome bonuses, cashback, airline miles, and other rewards to attract new customers. What many people don't realize is that credit card interest rates can change. Your issuer is generally required to notify you before certain rate increases take effect, but those notices are usually buried inside long emails or dense legal documents that few people actually read. If you're carrying a balance from month to month, even a small increase in your annual percentage rate can make your debt significantly more expensive over time. I'm not saying credit cards are bad. Used responsibly, they're incredibly convenient and can even provide valuable rewards and consumer protections. The key is simple. Whenever possible, pay your statement balance in full every month. That's how you enjoy the benefits without letting interest work against you. The sixth banking secret has nothing to do with fees. It's inflation. For decades, people have been told that putting money in a savings account is the safest financial decision they can make. And while your money may be safe from theft, that doesn't mean it's keeping its purchasing power. Inflation causes the prices of goods and services to rise over time. Something that costs $100 today will almost certainly cost more in the future. If inflation averages around 3% annually while your savings account earns only a fraction of 1% in interest, your money is quietly losing purchasing power every single year. This isn't about investments that are designed to grow over time. It's about cash that's sitting idle in a checking or low-yield savings account, slowly buying less and less as prices continue to rise. The seventh banking secret is that your financial activity isn't invisible. Banks are required to monitor accounts for unusual or suspicious transactions and report certain activity to government agencies as part of anti-money laundering and tax enforcement laws. For example, cash transactions above specific reporting thresholds can trigger required reports, and other patterns of activity may also receive additional scrutiny depending on the circumstances. That doesn't mean you've done anything wrong. It simply means the banking system is designed to monitor financial activity to help detect fraud, tax evasion, and money laundering. The eighth banking secret involves exchange rate markups. This is different from the foreign transaction fee we talked about earlier. Whenever you make a purchase in another country's currency, that payment has to be converted into US dollars. Banks and card issuers often apply an exchange rate that's slightly less favorable than the wholesale market rate, keeping the difference as additional profit. For example, if the market exchange rate is $1 to 0.85 euros, your bank might convert the transaction at a slightly worse rate. That small difference may seem insignificant on one purchase, but it can become expensive over the course of an entire vacation or a large international purchase. Because these markups are built into the exchange rate itself, many customers never realize they're paying them. If you travel internationally on a regular basis, it's worth looking for cards that offer no foreign transaction fees and competitive exchange rates. In some cases, specialized currency exchange services may also provide better value than relying on your bank. The ninth banking secret is surprisingly easy to overlook. Some banks charge dormant account fees. If an account sits unused for an extended period, certain financial institutions may begin deducting inactivity fees from the remaining balance. The exact rules vary depending on the bank and the type of account, but over time, those charges can slowly drain money from an account you've completely forgotten about. Even a $100 monthly fee adds up to $120 over the course of a year. That's why it's a good idea to periodically review all of your checking, savings, and other financial accounts. Closing accounts you no longer use, or keeping them active when appropriate can help you avoid paying fees for absolutely nothing. If the account doesn't have much money in it to begin with, those fees can slowly eat away at the entire balance. The problem is that many people never notice because they rarely check accounts they no longer use. Then one day they log in or try to use the account and discover that a surprising amount of money has disappeared. It's even easier to overlook if you have multiple checking or savings accounts spread across different financial institutions. The simplest way to avoid inactivity fees is to keep the account active. A small deposit, withdrawal, or automatic transfer every few months is often enough to prevent the account from being classified as dormant. And if you no longer need the account, don't just stop using it. Withdraw the remaining balance, formally close the account, and confirm with the bank that it's been fully closed. Taking that extra step can help prevent unexpected fees or complications down the road. Now that you know these 10 banking secrets that most people never learn about, you're already ahead of the average customer. But the next question is just as important. If leaving all of your money sitting in a traditional bank account isn't always the smartest move, where should you keep it instead? In the next video, I'll walk you through 7 smarter places to keep your money, depending on your financial goals, so you can make your cash work harder instead of letting it quietly lose value. Go watch that video next.